Okay, so my segment today is going to be on investing in dividend growth stocks, and I'm actually going to do this in the context of the current interest rate and fixed income environment right now. We obviously saw a very sharp increase in rates, bond and GIC yields over the last year and a half. And just recently, those rates have started to come down. So how do dividend stocks and dividend growth stocks fit into your portfolio in the current environment? So just to give a little recap on what dividend growth investing is and why it's attractive generally, dividends are essentially, it's a way of generating income from your stock portfolio. So dividends provide cash flow to investors. Now, this can be used as income for investors that need that income, but it can also be reinvested in the stock market or in other investments. A sustainable dividend growth, so for dividend growth stocks, this can help drive the stock price returns over time. And the best and the most well-managed companies generally do pay dividends. So there are groups of investors out there who don't need dividends, aren't necessarily attracted to income in their portfolio, but you wouldn't want to dismiss dividend paying stocks just because they pay a dividend. If you're to do that, you're essentially ignoring some of the best companies out there. And finally, what I'm going to get into later on is that dividend growth stocks on average actually substantially outperform non-dividend payers, and they do this with a lower level of risk. But let's take a look at dividend stocks versus fixed income stocks and what the differences are. Because right now, particularly in the higher interest rate environment, a lot of people that were attracted to dividend paying stocks in the past have really been reconsidering fixed income and adding more fixed income to their portfolios. So the most important thing, or one of the most important things to understand with a dividend, is that a dividend payment is at the discretion of the company. So dividends are typically paid on a quarterly or monthly basis, and the board of directors of that company is going to decide and at every payment frequency whether or not to pay a dividend. So they can increase the dividend, they can reduce the dividend, they can also eliminate the dividend solely at their discretion. Now, fixed income, which would be bonds or GICs, they work differently. The interest payments are a legal obligation of the bond issuer. So if you purchase a bond, whether from the government or even from a corporation or a GIC from a bank, you have a legal entitlement to those interest payments on the frequencies essentially that you originally agreed to when you purchased the bond, that are part of the bond's covenants. Now, if you're investing in a corporate bond, there's always the possibility of a default of the company, but only in the case of a default or bankruptcy can they avoid making those interest payments. It is a legal obligation. Now, on the flip side, dividends do have the opportunity to grow. So dividend growth stocks, these are companies that, because they're growing businesses, they have the ability to increase their dividend payments on a consistent basis, usually on an annual basis. And what this does is this produces a compounding effect on the income return. So if you invest $1 in a stock today and that company is increasing its dividend per share on an annual basis, then your yield on that investment in today's dollars increases over time. Whereas with fixed income investments, these interest payments are fixed. So they are an obligation. They're more guaranteed, but they're also fixed. So the interest payments don't increase over time. And that means that whatever your income yield is really just going to reflect the current interest rates of the day. Now, when you purchase a bond or any type of fixed income investment, there's going to be a maturity date. So for example, you might purchase a 1-year GIC or a 5-year GIC. That means when that maturity date comes due, you're going to be repaid that money that you invested in the bond, and you're no longer going to receive any interest payments. So at that point in time, you're going to want to have to reinvest that money if you want to continue to generate interest income on it. Now, if you're reinvesting that money, you're basically just going to get the interest rate, the current interest rate, and that may be a higher rate than your original, the interest rate on your original investment. It could be the same or it could be lower. You just don't know. It's impossible to predict where rates are going to be in the future. But this is a chart of the GIC rates for the 1-year GIC going back to 2019. And we can see here, 2021, up to 2022 where rates started to increase. Rates were almost zero. So at that point in time, for most investors, there was really no reason to consider fixed income or GICs. You just weren't generating any type of return. But then from 2022 upwards to 2024, the current year, rates suddenly started moving upwards. And they hit a peak in 2023 of about 5.1%. So about a year ago, they hit this peak of 5.1%. Since then, they've come down somewhat. We've seen the Bank of Canada reduce its interest rate twice now in the US. The Fed is expected to start reducing their rates after a couple of years of increases. So bond yields have already reacted to this, and we've already seen bond yields, GICs, come down. Right now, the current rate on average on a 1-year GIC is about 3.9%. So the way this would work is, say a year ago, you had money to invest and you decided you would put it into a GIC. You could buy a 1-year GIC and you would have made 5.1% interest rate on that 1-year GIC. So that's pretty good. Certainly if you're comparing that to many dividend stocks, and I know I had this discussion with investors a lot, they would say, well, why should I take on greater risk by putting my money in a dividend stock when I can get an fairly equal income yield by just putting my money in a GIC, which is guaranteed. So I'm going to explain, or illustrate how this is not an apples to apples comparison. And that really comes down to that compounding effect of dividend growth. But say you were to purchase that GIC a year ago, you got your 5.1%, you're very happy. Now the year has come due, the maturity date has come due, you've received that money back from your GIC. Now you have to figure out what to do with it. Now, if you want to put that back into a GIC, your return now on that money is going to be 3.9%. So you're going to actually see a reduction in your income yield. Now, if you're an investor who really relies on that cash flow, fixed income, the risk really involved here is that you don't know what the interest rate is going to be in the future. So, you might be happy with that 5.1%, 3.9% might be okay. But when you renew that GIC a year from now, it could be 2%, it could be 1.5%. You may be getting almost no income yield on it at all. So this is one of the risks of investing in fixed income. Now, a GIC is risk-free from the perspective that there's essentially no default risk, because if you're buying it from a reputable bank, it's insured. So there's no issue with getting your money back or your interest payments. But the risk is that you don't know what rates are going to be when the maturity date becomes due and you need to reinvest that money. Now, let's compare this to a dividend stock. And I'm just going to use an example of a long-term investment that we made at KeyStone, long-standing recommendation going back all the way to 2021. This is Brookfield Infrastructure. The symbol is BIP.UN. So Brookfield is what we would consider to be an income growth stock. When we originally recommended the company back in 2021, it was paying annualized distributions of 53 cents US, and it's essentially increased its distribution every year over that period of time. So just turning out cash flow, growing the business, growing the cash flow per share, and increasing that income distribution every year. So that income distribution is essentially almost tripled from 2011. So every year, you're essentially getting a higher dividend or distribution on your investment than you did the year before. Now, what does this look like in terms of extrapolating it going forward? Well, the current yield on the company right now is 5.2%. Now, they're generally targeting distribution increases in the range of about 6% per year, sometimes a little higher, sometimes a little bit lower. Now, if you were to take that dollar that you're investing today, or whatever you're investing today, your income yield on that today is going to be 5.2%. But assuming that they continue to increase their distributions at an annual rate of about 6% per year, if we extrapolate this going forward 5 years, then your income yield now on that dollar invested today is actually close to 7%. It's about 6.9%. And if we were to extrapolate this out again, another 5 years, so 10 years in total, your income yield on that dollar of investment today is 9.2%. So this is what I mean by the compounding effect of growing distributions and growing dividends. You're actually generating a higher stream of cash flow on every dollar invested today. Whereas with GICs, fixed income, they can't replicate this. And this is why it's really comparing a dividend growth stock with a fixed income investment is just, it's really an apples to oranges comparison. Fixed income, as the name implies, is fixed until the maturity date when you don't know what your income yield is going to be. For a dividend growth stock, as long as you invest in a company that is a strong fundamental business and continues to be able to grow its cash flow per share and its dividend per share, then you're going to get an ever increasing stream of dividend income. And this is one of the reasons why we think that dividend growth stocks are very attractive investments. Now, just to look at Brookfield Infrastructure, just to give you a little more information on how this looks, like what this cash flow profile looks like. If we were to take based on our original recommendation price in 2021, which was about 950 Canadian per share, this company has paid out total distributions over this period of time of almost $14 US, so well in excess of our original recommendation price, just paid out in cash flow. Plus, you still have a company that's paying an attractive yield. You still have a company that has that's continuing to grow and produce share price appreciation. Now, the accumulated distribution growth over this period of time is 189%. And the yield on that original purchase price, so every dollar that was originally invested in the company back in 2011, based on today's distribution, is about 22%. So this really exemplifies the profile, really the ideal profile of what we would consider to be a dividend growth stock. And this sets dividend growth stocks well apart from fixed income. Now, if we look at the historic performance of dividend growth stocks, we can see that actually these strong fundamentals or the strong cash flow profile really shows up in terms of performance. So there's data calculated every year from RBC Capital Markets comparing dividend payers and dividend growth stocks with the rest of the market going back to 1986. So if we look at dividend growers over this period of time, they produce an annualized return of 10.8%. Now compare this to the average for the TSX, 6.2%. Certainly strong outperformance there, but then compare that to non-dividend payers, so companies that don't pay dividends, only a paltry 1.1%. So massive outperformance for dividend growers, but also better performance in terms of risk. So same time period, but this measures annualized volatility. So annualized volatility essentially is just a measure of how widely a stock price fluctuates. We can see dividend growers on the left, annualized volatility since 1986 on average of 13.3%, less than the overall market, and then again, significantly less than non-dividend stocks. So higher returns and lower risk, and that is really the recipe for investment success. Our belief is that dividend growth stocks really should form the foundation of an investor's portfolio. This doesn't mean that you can't have fixed income. It certainly does not mean that you shouldn't have more growth-oriented stocks that don't pay dividends in your portfolio. But really, dividend growers form the base, the foundation, and then from there you can augment that return by adding layers of risk, such as more exciting themes in technology, growth-oriented stocks like small caps, profitable small caps. But we really believe that systemically you would set yourself up at a disadvantage if you don't make dividend growth investing an important part of your portfolio. Now, just in terms of the current environment, as I had mentioned before, rates are starting to come down. We don't know where that's going to trend, how low they're going to go. But as rates went up, what essentially happened is that a lot of investors psychologically became less interested in dividend paying stocks. So we saw valuations compress. A lot of the sectors that are associated with lower growth, more consistent dividends, but lower growth, which might be utilities, REITs, few other segments of the market. They've not performed well over the last couple of years due to that rising interest rate environment. Now we're seeing that reverse. We're seeing interest rates start to come down. And if this continues, then we would expect to see more investor interest and more investor capital flow back into some of these dividend sectors. So we do believe that there is a good opportunity right now over the next couple of years to purchase good, solid dividend companies, many dividend growth stocks for attractive valuations, and set yourself up with a good stream of growing income in the future, as well as some capital appreciation as well. So we have our research right now. We're in the process of putting together a Canadian REIT report, which covers all 40 Canadian REITs in Canada, and making our top picks. And then we're also looking at utilities and other areas in the dividend space as well, just in the context of the lower interest rates. But really, as a long-term solution, we think that dividend growth stocks have to be a part of every investor's portfolio. Right? Thank you.
Yeah, so that's always a great point, Aaron, especially when we're not directly around you. It's even better. But the great thing about income stocks versus dividend or versus fixed income really is that growth. But also, a lot of people don't pay attention to the risks of fixed income as well, which Aaron did mention it. When you are, it's called rollover risk, is when it matures. You have to reinvest into that next fixed income instrument. And even if you're not doing it directly, if you're buying, let's say, which many people do, a bond ETF of the likes, is you're still facing that rollover risk, but it just goes over time. And that is something which a lot of people do, is they'll just pick up a bond ETF and they think, oh, I'm not facing that rollover risk when something matures, because the ETF itself doesn't mature, but the underlying bonds or whatever fixed income instrument you're using, normally will be bonds, do mature. So you're constantly facing this rollover risk. So you are always realizing at the same time that those lower and lower interest rates, versus a dividend growth stock, normally it will slowly go up. And of course, you do need to see for a dividend growth stock for it to be supported by underlying cash flow and net income, likely both. And if you don't have that, it won't become a dividend grower, because obviously your hindsight, it's, a dividend grower once you've looked at it over time, but you need to also look at it ahead of time. And when you do have some stocks that will pay a massive dividend, they had a one-off great quarter, great gain, they'll issue and say, oh, we're going to start issuing a dividend. Then you'll see a year or two down the line, they have to cut the dividend completely or neuter it quite a bit because they didn't have that supporting cash flow, versus, let's say, something which is just great and has that cash flow. And that's really what we're wanting to see, is cash flows support the dividend growth, and that builds over time, and they're able to reinvest. And that's really the key to dividend growth stock versus fixed income. You're not going to ever have that.
Yeah, and I'm not sure if Aaron touched on the power of the compounding that dividend over time. If you have it if you're growing that dividend over time, we have some effective yields like Hammond Power. If you bought it just 4.5 years ago in the 6-7% dividend range, it's now 8. You're getting paid every year 18% if you bought it at that $7 range. Tremendous. Dynacor was, when we originally recommended it, didn't even pay a dividend. Now you're getting, on that $1.80 to $2 originally purchase price, it's gone up to 5+, but you're getting around an 8% yield on that, and it's growing every year as well. So that really, can really produce good returns over the year, and allows you to stay in that stock even as it trends sideways and then goes on a next leg up over time. So dividend growth stocks, a great way for to have a core part of your portfolio and growth over time. And they there could be some of those names, if rates continue to come down, that you could get suddenly everybody, oh, I'm in love with dividend stocks again. And you should always be there with the dividend growth names, but then you get a more premium versus a discounted multiple on some of those names.
Dividends or go on, Brett, sorry.
Oh, I was just going to say, normally you'll see them dividend growth stocks will move kind of along with interest rates as they fluctuate. It's how the stock market works. It's all interconnected. I'm not going to dive too far into that. But when we are in now likely a rate cutting cycle, at least for Canada, likely the US at this time, it's almost a certainty, is you'll start to see investors who were in fixed income they're at 5-6% fixed income rates right now. If once it starts to go down to 4, 3, 2%, they might migrate into to these dividend growth stocks, which will drive the price up. You get that capital gain as well, and yet you're still getting your effective yield.
Yeah, and all I was going to say is just, I think that dividends are so underrated. I mean, I know that a lot of investors prioritize them in their portfolio, but especially for like younger investors, when I was in university, I wrote them off. I was looking for, the 10x potential stock in the wrong place to look for the 10x potential stock, but it's because
the diamond in the rough.
Exactly, the diamond in the rough, you could say.
Literally, yeah.
Literally. But that's the thing. There's nothing that I love more than looking at my account and seeing my cash balance grow, knowing the date that the dividend hits. Again, I'm boring, but it's quite exhilarating to me.
We're not going to argue with you, Brennan. We're not going to argue with you.